All right, welcome to The Explainer. Today, we're putting on our financial detective hats to look at a company that has honestly completely polarized the market. I'm talking about DigitalOcean, ticker symbol DOCN. Now, if you follow cloud computing, you absolutely know this name. And on the surface, this stock's performance looks like an absolute dream scenario. It's a financial masterpiece. But you know, when we actually pop the hood and look at the underlying mechanics, we find this massive, high-stakes battle between extreme optimism and some pretty harsh fundamental realities. It's a true bull versus bear paradox.
Okay, let's dive into this. 212.07%. Let that sink in. That is DigitalOcean's trailing 12-month return. So if you had money in this stock over the last year, you literally more than tripled your investment. In a market where, let's be real, a 10 or 15% annual return is usually considered a massive win, a 212% surge, well, that demands our immediate attention. So the big questions are, how did they pull this off? And more importantly, is it actually sustainable?
To answer that, here's our roadmap for this explainer. First, we'll track the DigitalOcean rocket ship. Then we'll build the bull case by looking at their explosive growth and profits. After that, we need a severe valuation reality check, followed by a look under the hood at debt and liquidity risks. And finally, we'll try to make sense of this wild paradox.
So, Section 1, the DigitalOcean rocket ship, a wild ride since 2022. Let's take a look at the insane momentum of this stock. Historically, holding this stock has been an absolute roller coaster. I mean, 2022 was just brutal, leaving investors with a negative 68% return. Ouch. But look at this recovery. We saw a solid 44% bounce in 2023, a tiny dip in 2024, and then a 41% climb in 2025. But 2026, that is where things went absolutely parabolic. A 100.4% year-to-date return. This isn't just steady, incremental growth, right? It's a total momentum explosion. Which brings us to Section 2, explosive growth and profits, or the bull case. Let's look at the actual fundamentals driving this incredible surge.
And this brilliantly illustrates exactly why investors are just throwing money at the stock. Look at the acceleration in their net income compound annual growth rate, or CAGR. Over 5 years, net income grew at a really impressive 64%. Over 3 years, that growth basically doubled to 124%. But the trailing 12-month figure? A staggering 206.85%. Their ability to generate profit is accelerating at literally breakneck speed. And that profitability really shines through when we look at their margins. DigitalOcean boasts a gross profit margin of nearly 60%. Basically, for every dollar of revenue that comes in the door, they keep 60 cents before operating expenses. And it gets better. Their net profit margin is sitting at a fantastic 19.48%. In the tech and cloud infrastructure space, pulling an almost 20% net margin makes this look like an absolute slam-dunk investment. The underlying business model is clearly working and it is generating some serious cash.
But before we get too comfortable here, Section 3, the valuation reality check, the pivot. Because as we know, buying a great business at the exact wrong price can still be a terrible investment.
And that brings us to the absolute most critical question of this entire explainer. Is the rocket running out of fuel? Like, have investors gotten so incredibly hyped about the growth we just looked at that they've bid the price up to a genuinely dangerous level?
Well, prepare for a bit of a gut punch. The current trading price sits way up there at $96.43. But the fair value price, which is calculated based on discounted cash flow models, is just $21.64. And remember, a discounted cash flow model fundamentally asks one simple thing. How much cash will this business generate in the future, and what is that cash worth right now, today? So based on those hard-cold numbers, DigitalOcean's intrinsic value is literally a fraction of its current trading price. Which leads directly into this honestly terrifying metric if you're a value investor, a margin of safety of negative 345.52%. Now, what does that actually mean in the real world? Well, a normal positive margin of safety protects you if the company hits a speed bump, right? It gives you a cushion. But a massive negative margin of safety? That means perfection is already priced into the stock, and then some. You are paying a severe premium, assuming the company is going to execute flawlessly for years to come. There is absolutely zero room for error here. Now, what's really interesting about this slide is how rapidly the market's expectations have shifted. The price-to-earnings, or PE ratio, tells us how much investors are willing to pay for just one single dollar of earnings. DigitalOcean's current PE ratio is 39.04,
but its own average over the trailing 12 months, that was just 25.08. So the stock price is soaring over 55% above its own recent historical valuation. Essentially, the stock price is simply outpacing its own phenomenal earnings growth. And hey, if you prefer to look at cold, hard cash rather than accounting earnings, the picture gives even more extreme. The price-to-free cash flow ratio has hit a staggering 263.47. To put that into perspective, that is up over 95% from its trailing 12-month average. Free cash flow is the actual lifeblood of a business, folks. Paying 263 times that cash flow is the financial equivalent of buying a Honda Civic for the price of a Ferrari. It adds massive fuel to the overvaluation argument.
Let's move to Section 4 and see how this builds into debt and liquidity risks, taking a look under the hood. Because honestly, valuation isn't the only thing the bears are sweating over right now. We have to look at the balance sheet.
These right here are the metrics that keep risk managers awake at night. The current ratio and the quick ratio both sit at 0.69. And here's why that is a huge deal. A ratio below 1.0 means that for every single dollar of short-term liabilities the company owes over the next year, they only have 69 cents in liquid assets on hand to actually pay it. That is a glaring red flag for short-term liquidity. Combine that with a severely negative debt-to-equity ratio of negative 49.71, and you quickly realize that despite that explosive net income we talked about, the financial foundation is carrying some seriously heavy leverage and liquidity risk.
So, Section 5, Making Sense of DOCN. The ultimate paradox. How on earth do we reconcile these two completely opposite realities?
So, the crucial point is this stark, undeniable contrast. On one hand, the bull reality shows a stock delivering a 212% return, all backed by an incredible 206% net income growth. It's this gorgeous, high-performance exterior. But then, you flip it over to the bear reality, and it reveals an engine that is running extremely hot, with a precarious 0.69 current ratio and a frankly terrifying negative 345% margin of safety. It's a fundamental clash between undeniable business momentum and incredibly stretched financial realities.
Which brings us to the end of our analysis. And honestly, it leaves you to play the financial detective. DigitalOcean is either the cloud computing rocket ship of the decade that will eventually grow into its valuation, or it's a massively overvalued bubble just waiting for a harsh reality check on its balance sheet. Explosive growth or massive overvaluation? Which side are you on? Let that simmer for a bit. Thanks for joining me on this explainer, and I'll see you in the next one.